So I'm the co-founder and chief investment officer of Bletchley Park Asset Management, which is a hedge fund focused purely on investment in digital assets. And it really owes a lot to Russ Newton and Global Advisors being the pioneers in the space. So without them, we wouldn't be here today. Now, when I was initially approached by people over at Digital Jersey to present on this topic, I was quite excited. I thought, yeah, it's great. I can share my experience over the last 12 months. And then I sat there over the weekend putting together all the challenges and some of the factors that Russ has just highlighted and realized, why on earth have I started a crypto hedge fund? And so hopefully this isn't going to be too pessimistic, and I'll close with talking about some of the opportunities that the blockchain technology will bring. And I think Russ pointed out earlier quite clearly that the size of the crypto asset class right now is tiny. It's 200 billion. Versus global asset 285 trillion. It's not that it's not that crypto assets are going to overtake those other assets. It's the methodology used in blockchain is likely to cannibalize them. So rather than doing an equity raise, we'll start to see people use the underlying blockchain technology to create kind of token-based equities. And because of that, there's a huge opportunity here for that crypto asset class to grow. Now, as Russ pointed out, the amount of shitcoins, only one count so far on shit usage, is huge. And so it's unlikely that the tokens we see today are going to be responsible for that growth. And so for me, as a traditional equity investor, what I'm looking to do is to be the first person in as a hedge fund that's focused on the cannibalization of traditional assets onto the blockchain. Okay. So before I get into the operational challenges, I'm going to talk a little bit about the market challenges. Transparency is a central issue within cryptocurrency. It's transparency around the actual liquidity in the market, and then also transparency on the exchanges. So generally, you'll pick up or you'll read an online blog, and there'll be a hack at the exchange, and that creates a huge amount of uncertainty for investors when they're investing with us. They're always asking, how do we manage that exchange risk? And so we have to have a good answer for that, whether it's diversification or keeping coins off of the exchanges. Liquidity for execution is always quite a challenge in any market. But when we look at crypto, the average volume in Bitcoin is 846 million, which sounds reasonable. As soon as we drop out of the top 10 in crypto, it rapidly drops down to about $10 to $20 million a day. And so one of the big hurdles for institutional investors coming in is just to find enough opportunities of the right scale. And it's a little bit of a chicken and egg in that you need these investors to enter the ecosystem so that other service providers, JP Morgan, et cetera, will provide the infrastructure for them to invest. But they're not going to invest as long as the investable asset class is very small. And so I was quite fortunate to speak to somebody over at SoftBank, and they just missed the whole idea of cryptocurrencies for the next couple of years, just because their bite size is so enormous compared to the size of the liquidity within any of the coins outside of the top 10. So this creates a bit of a market challenge, and especially for a hedge fund manager like myself, when I'm trying to convince these people to allocate capital to me, for them to allocate into the market. They're very critical that there's enough opportunity in there in the right kind of scale to create a viable hedge fund. As ever, volatility always presents a market challenge, and obviously in an asset class it's very difficult to hedge, or you can only hedge with Bitcoin. This creates a certain problem creating a true hedge fund per se, and so that volatility in a long-only product is quite painful and leads to a lot of quite angry investor calls. Okay, so I'm going to focus on the operational side of why is it so challenging to create a cryptocurrency hedge fund. One of the big problems that I face, and it's a sensible problem, or it's a sensible issue that investors raise, is the actual volatility of the underlying asset class, or the volatility of our hedge fund, means that they need to downsize their tickets. And so if you had a large allocator who are looking to put money into a fixed income fund, typically they might invest $100 million, $50 million. They then look at an equity long-short fund. That ticket size goes down to $10 to $15 million. You then get to a crypto-sized hedge fund with a volatility of 40 vol. Suddenly that ticket size has gone from millions of dollars to hundreds of thousands of dollars. At the same time, your fixed cost of running a hedge fund has not changed. So, if you're Brevin Howard, your client onboarding fees is probably the same as mine. And so my cost-expense ratio is terrible when I look at the individual tickets I'm onboarding. And then again, more of the savvy investors will begin to look at the performance of the fund in terms of, the fees charged, 2 and 20, but then also look through to that cost-expense ratio. So it creates another challenge to overcome with investors, where we have to sell the dream that the returns are there in the future, and then the cost-expense ratio should just be ignored until we get bigger. But it's not always easy to convince them of that. Another issue we have is there is a huge amount of liquidity out there via the ICOs, as Ross pointed out, that people have raised money, and now they're looking to diverse away from the ether that they've raised capital in. And so we've been trying to get them to give the money to us, and we perform a treasury management function. However, this creates certain issues around the provenance of these coins with regards to onboarding with our administrator. They want to know, what was the source of them. And, crypto evangelists are not always forthcoming in assisting us create a good fact pattern of how they managed to raise the assets, where did the ether come from. So that creates a bit of a challenge from the onboarding perspective. Operationally, running a crypto hedge fund has many similarities to a traditional equity long-short, but the big differentiator is there's no prime broker in the middle to reconcile your positions. So if you're running an equity long-short, you'd have a three-way reconciliation process between administrator, PB, and yourself to ensure that all positions and balances are correct. So within crypto, we have to develop our own processes of reconciling our exchange balances versus the administrator, but there's no real third party that we can use to have an extra set of eyes on it. However, the benefit of blockchain technology is that the ledger is immutable. And so when we actually have assets transferring in and out, it's a much easier process to reconcile rather than calling Goldman Sachs and asking for your trade files and beginning to manually reconcile. Operationally, counterparty risk is a big problem. When we decide to onboard a new exchange in order to build out our trading capabilities, getting access to understand the balance sheet status of an exchange or any custodian is very challenging. And so that means it's very difficult for us to right-size our bets. Coming into or having lived through the financial crisis, most people were on the wrong side of the Lehman Brothers trade, and it was only when the headlines really started hitting the tape that people started shifting balances from Lehman Brothers into their other prime brokers. In crypto, you've got even less visibility, and then also when the moves happen, whether it's a hack or some form of, poor governance at the exchange, the move is instantaneous. That money is lost. And so trying to push for greater transparency during the operational onboarding phase is a big challenge. So assuming that we can get to the stage where we're getting reporting from our exchanges, we've assessed the counterparty risk to a level that we're comfortable with, and we've right-sized the amount of assets that we'll put on that exchange. The next level is kind of procedural standards, where if you're dealing with Goldman Sachs or JP Morgan, it's a known process for trade reporting at the end of the day and how those processes reconcile. Again, in crypto, when we're pulling reports off exchanges or using API to automate this process, there's very little standardization, and APIs differ dramatically across exchanges. Okay, so assuming we can get through the operational challenges, the next thing we have to look at is the valuation. So we've traded, we've created a portfolio, we have assets there. How do we convince investors that the valuation that we provide in the NAV statement is reflective of the underlying assets? And again, this is challenging because there's a lot of bad publicity out there in the market. People talk a lot about wash trading on the exchanges or inflated volume, and we've talked about the ICO phenomena where there's a lot of bad actors and there's a lot of automated bots that can be used to inflate liquidity and therefore inflate price. And so establishing a trusted reference rate is quite challenging. Easier in the larger coins where we can take a simple mean across 4 or 5 exchanges, but as we drop down the liquidity to the more interesting investments where maybe there is cutting-edge tech being developed, finding a reference rate to validate our asset price is challenging. And And even if we do find the right reference source, the volatility around it and the timing of it creates quite a challenge when we begin to look at portfolio rebalances when we have capital coming in and out each month. If you were to imagine in a traditional equity portfolio, last day of the month, you get new money coming in, the market's closed, you know how much you have to reweight the portfolio on Monday morning. It's quite easy to do. In a crypto market that's constantly live trading, when the new money comes in, you need to snap the reference rate and then also readjust the portfolio almost instantaneously. And so that means when we assess our market snap time, we can't use a close of business rule like we would in traditional equities. We have to have access to live banking during market hours in order to rebalance the portfolio to ensure that we have continuity for new investors coming in. When I was setting up Bletchley Park, we were looking at where could we be domiciled and run a regulated cryptocurrency hedge fund, and we created a shortlist, and it was kind of Cayman, Switzerland, Singapore, Jersey, and you kind of started creating a matrix to score off each jurisdiction about where's the best place to go. And actually we owe Global Advisors a great deal of gratitude for this, because they were actually the first regulated cryptocurrency hedge fund in the space. And as much as we didn't want to go into their backyard, when we scored everything, actually Jersey came out on top. And so unfortunately we decided to come here and try and add a little bit more crypto depth to the island. But having decided on a jurisdiction that you can actually run your business in and achieve a regulatory status, it's no cakewalk after that. It requires a constant dialogue with a regulator to deal with the issues that will crop up. And since I came to Jersey, the initial guidance was to only deal with regulated exchanges. And then through interaction with the JFSC and demonstrating due diligence around the exchanges that are yet to be regulated or have demonstrated strong control processes, we've been able to move that forward into dealing with a greater number of exchanges. So it requires a great deal of collaboration, and there's no easy rubber stamping, you're a cryptocurrency hedge fund, off you go, start trading. The choice of regulatory jurisdiction, is quite a challenging one based upon the appraisal of the cryptocurrencies in terms of how the asset class is treated. Obviously in the US, they're leaning towards commodities. Japan, it's recognized as a currency. In Hong Kong, they're very much in no man's land, and I reference Hong Kong as I spent 12 years of my career there working with traditional equities, and there's a huge amount of innovation and tech taking place in Hong Kong, but the regulator is in a very difficult position where they generally will follow the SEC for guidance on how they should proceed. However, they're heavily influenced by the PBOC, which has put an outright ban on cryptocurrency trading and mining. So at the moment, they're in a very difficult position. And so when we're looking to launch our fund, being domiciled in an area where legally we could execute as a cryptocurrency fund, but there was no guidance on how that would then shake out. And obviously, if you're running a hedge fund and suddenly your asset class is treated as a commodity, the infrastructure required for that and reporting obligations are quite different. And I think for my view on this, when I look at cryptocurrencies, I think we need to get beyond the moniker of cryptocurrencies and really start thinking about digital assets in terms of, is it a true utility token? Is it an equity? Is it debt? As I said earlier on, I believe the blockchain methodology will cannibalize most equity and debt issuance over the next 5 to 10 years. And so we really need to move away from this cryptocurrency moniker and start thinking about digital assets and what existing regulatory regime bucket do they fit in? And then if it is none of the above, then is it a true utility token? And let's start focusing on that particular segment of regulation. The final issue we have is tax. Owing to the various regulatory statuses around the world, that has a big impact on how the taxation of the underlying assets is treated, and as Russ pointed out, how they're accounted on the balance sheet. Again, I'll pick on Hong Kong, but they have a certain number of exemptions for asset classes there to define whether it's tax exempt or not. Fortunately, in Jersey, operating in this jurisdiction, there is a tax exemption on the profits. But in various places around the world, there's no clear definition of how the asset should be treated, and that creates an undefined tax liability, which creates a big overhang when you're creating a hedge fund. Again, until we had found a jurisdiction where we could treat, where we have no tax liability, it was very hard to get investors interested in the product. So that's pretty much all the negatives, and that kind of ruined my weekend and forced me to think about what am I doing? Maybe I should go back into equities. But then after that, I kind of sat back and tried to think about some of the positives that would come through from this technology. And one of the big pain points, and this is not just limited to a cryptocurrency hedge fund, but it's all hedge funds in general or any asset manager, is the onboarding process. The need for paper documents and wet ink certified documents to be sent in for the subscriptions is just a massive pain. And so using blockchain with a secure ledger where we can have a very high security around KYC and identification, hopefully we can begin to move the onboarding process into the 21st century. Because right now, using very limited, cheap scanners is very easy to replicate and fake documents. And so wet ink copies creates peace of mind for the administrator, but I don't believe it's actually materially improving the security of the process for onboarding in any way. Also, when we look to the future, earlier on I flagged the issue of the lack of reconciliation between exchanges and ourselves and our administrator. When we see blockchain evolving such that there's interoperability between the various blockchains, it'll mean that we can create application layers that sit over the top of this, and we can have real-time reconciliation of position-level data, which is going to be a blessing and a curse. It's great you have real-time reconciliations. You don't have to pull off trade reports and run them through a program. The curse of it will be that you'll be able to provide investors real-time performance data. And any investor in a highly volatile asset with real-time investment data is going to call you every time it moves 1%. So it's a blessing and a curse as an asset manager. As I said, the position-level data will allow some P&L reconciliation as well. That's the end of the presentation. I just wanted to touch on one thing. People asked about banking in Jersey, and I would say that the issue of banking isn't just limited to Jersey or cryptocurrency hedge funds. It's all hedge funds, around the world. You could have $1 billion in assets at the moment, and then get a call from, say, DBS Bank in Singapore that they no longer want to provide banking services to your hedge fund. And it's just a business that the banks don't want to be a part of. And so I think there is a real opportunity for a challenger bank to enter, and specifically within crypto, a challenger bank that can bank crypto could have a huge advantage there. And I see no reason why such a bank couldn't be formed in Jersey.
Thank you very much. Pleasure. Great stuff.